Moving on to chapter 11, receivables. We talked about cash in chapter 10. We will be talking about receivables in chapter 11. Okay, of course, this includes auditing notes receivables and account receivables. Okay, and the biggest risk over here sometimes has been, it's a subjective area recognition of revenue. For example, in Enron, we saw that they recognized revenue when they should not be recognizing, or you can say there was no specific criteria, or you can say the mark-to-market rule was what you may call manipulated in their own favor. So how to recognize revenue, or the criteria for recognizing revenue, is important. Agreement exists, delivery has occurred, or services have been rendered. Otherwise, it's unearned. Okay. Seller's price to the buyer is fixed or determinable, and the collection is reasonably assured, or otherwise this becomes bad debt, right? So those four issues need to be looked upon, and need to be looked upon very clearly. Okay. So steps involved in auditing this receivables. First, we determine what the revenue is going to be. The next part is going to be auditing the receivables. Okay. As always, we need to understand the client environment. How can we understand that? Understand the industry in which they exist, reasons for increases in sales, decline in sales, meaning the business criteria of how there is an increase or decrease, the procedures for collections. Okay, you can have revenue, but you also need to be collecting that, or the inability to collect, the bad debt expense. Okay. Overly aggressive management will recognize revenue even when revenue is not fixed. For example, we saw with Enron. Okay, so the revenue recognition process, do they believe in doing the right thing? That control environment issue we talked about. And because that's a risk here. If they do not have specific criteria for recognizing revenue, and they're not following the gap principles, we have an issue. So those things need to be understood clearly before you start receivables and their audit. Okay, and once you understand your risks involved, then you can start the process. Of course, the first thing is obtaining an understanding of internal control. Again, as I said, redundant, but we need to keep on re-emphasizing. All right, internal control questionnaires, written description of the process, or a narrative will help you understand the entire process of receivables, from the sales being consummated to the point of receipt of payment, cradle to grave kind of analysis. Once you have the description of controls, of course you need to do your test by pulling out samples. Okay, and so for that we need to understand the AR cycle in the textbook. So let's go ahead and let's look at the AR cycle in the textbook. Okay, all right, so let's take a look at this. First thing first, you need to get a purchase order from the customer, right? Based on that, you'll prepare the sales order. Of course, the department in charge of preparing the sales order or doing the sales should not be in charge of a credit approval. So then there will be a credit check done. Okay, you have this many copies of sales orders going to various departments. Okay, of course, one of them goes to customers, one of them goes to credit approval. All right, one of them goes to accounts receivable department, one of them goes to the shipping department. Okay, and then based on that, they'll prepare the bill of lading, and once the bill of lading is prepared, the merchandise is then shipped to the customer. All right, so you need to have the sales order ready first to get the sales process going. Okay, a credit check also needs to be ensured, and then on the second page you sort of have approved sales order, bill of lading, customer's purchase order, and sales order, approved sales order. Okay, and based on that you will then go ahead and enter it into the system. You have the collections process, you have the ledger process. Here's the master file. Okay, and based on that you should also be getting an aging report. Once you get the aging report, you can think about the collections. So as you can see, a brief review of the process. You need to first have a purchase order based on which you'll prepare the sales orders. Okay, the sales orders will be sent to the various departments for one of them will be credit check. Once you get the sales order and it is approved, it's very important. This step is important. Then you can do a release with a bill of lading to the merchandise for shipping. Okay, and once you get that, you get the sales order approved, and you release the goods. Of course, you will then send out an invoice, and this is the department. We will send out the sales invoice to the customer. Okay, and then the collections process will happen. So this, in short, is the entire cycle for AR. Okay, and here is the customer orders. Once a purchase order is received, a sales order should be prepared. Your job would then be to pick a sample of sales orders and test them if they have been properly recorded in the financials. Test of completeness. Because you see some questions in this section. You're going from cradle to the grave. Picking another sample and matching them with shipping documents is a test of existence. Okay? You are going in the reverse order. Now, credit approval. Let's talk about that. Once sales order is prepared, credit department should implement the company's credit policies. You need to do a credit check for new customers and approve them as per proper procedures. Okay? Once sales order is prepared, credit department should implement the company's credit policies, do a credit check for new customers, and approve as per the proper procedures. Okay? Goods in storage can now be released once there is a credit approval. Good question is, who should maintain record of finished goods? Storekeeper, accounting department. Think about it. The people who are in charge of processing the ledger, should they be in charge of also being custodian of assets? So the answer obviously is going to be the storekeeper, not the accounting department, right? Goods should then be released from the floor room to the shipping department. So a bill of lading is prepared. Okay. Documents must be numerically controlled and entered in shipping register before forwarding it to the billing department. And then you need to test the numerical sequence of shipping documents. If you do that, it's a test of completeness. Anytime you see this question, numerical sequence is a test of completeness. Okay. So you have this internal control question. Taking a sample of shipping documents and comparing it with sales invoice will make sure that goods shipped were billed for. Why do I have all these questions? This is very important. Okay. Taking a sample of shipping documents. You take the sample of shipping documents and compare it with sales invoices. What is this telling you? So the shipping documents, and you compare it with sales invoices, what in a sense you're doing is you're making sure that everything that was shipped, actually invoices have been created for that. Okay, goods shipped were billed for. And then you move on to the billing function. Again, you're going to look for serially numbered shipping documents to make sure no documents are missing, right? Test of completeness. Compare shipping documents with sales orders and purchase orders. And then apply proper pricing and discounts as per contracts and policies. Test of valuation. Okay. Test of completeness. So those two things you are looking for. So if you take a sample of shipping documents and compare it with sales invoices, again, you're making sure all goods shipped were billed to customers. Why the redundancy here? You're going to see a few multiple choice questions on that. That's why. So taking sales invoices and matching them to shipping documents is a test of existence. Now, this is reverse. Okay? What you're doing is you're taking the last step and you're moving backwards to make sure that you build for everything that you have shipped for. All right? Existence and completeness. Important over here. Once you look at the existence and completeness test, you're also going to look at collections. Who is collecting and depositing checks? Are they preparing a remittance advice? Okay. Are receivables being reduced by posting them to proper accounts, subsidiary accounts? That is also important. The journal entry to make sure that it's being booked correctly in the ledger and subsidiary accounts if it needs to. But the process, insofar as collections is concerned, is followed properly, is also a part of your audit. Okay. Adjustments to sales and receivables. Now this is regarding returns. Okay, adjustments to sales and receivables should be done using a proper memorandum that is serially numbered, should be signed by an officer, approved by the treasurer. Okay, of course, is it a good thing? Of course not, right? Because what is the risk? The treasurer can sign if they are in charge of cash handling duties, they can manipulate and pocket the cash. So of course, by segregation of duties, this is not a good thing. All write-offs need to be approved by the treasurer. Okay, adjustments, meaning returns, should be done using a credit memorandum, and then you have the write-offs. So there also you need to make sure that proper procedures are followed. So here's a quick look at the substantive procedures. Let's take a quick look at this. While you're reviewing this, you need to take a quick look at this and see the audit objectives, because you will see some multiple choice questions asking you for, especially test of existence. With assets, the test of existence is very important. For example, interest earned on notes receivable, you could have more than it. Has it been recorded completely? Okay, the collections is a good one for valuation. Are your receivables valued correctly? What are the chances that you're going to collect all these receivables? Okay, do they have a bad debt allowance? Is that bad debt allowance booked in accordance with prior bad debt experiences? So those kind of things need to be looked at as well. And so these are the assertions right next to it given to you to make sure that everything is booked correctly. As you move forward, you can see that there is a test of confirmation. Now, what do we mean by confirmation? You are required as an auditor to confirm the receivables. You may pull out an aging schedule, you may pull out a subsidiary ledger, and you may pick out a sample to confirm that actually this receivables, look, somebody's receivable is other person's payable, right? So you need to confirm. The use of confirmations for trade accounts receivable is considered a required procedure by GAAS. If auditors decide not to use confirmation, then burden of proof is on them to justify this. May not be done in the following situations. Very small receivable, majority of them is cash collections, receivable is immaterial. You may decide not to do it, but you need to give a good reason. You started this audit pretty late. Okay, for example, I started one audit 6 or 8 months after the year was over because the bank said that if you want to get a loan, you need to get it audited. In that case, what can you do? And that's the issue. Combined assessment of inherent and control risk is low, and audit risk can be reduced to acceptably low level with substantive tests. Okay, there is not a high risk, but you're going to do a lot of testing, so it helps you. So you decided to skip that is okay as well. And then you have this positive confirmation and negative confirmation. You will see some multiple choice questions on this. Let's read this real quick. Positive confirmation. It asks the customer to respond if the balance is correct or incorrect. Negative confirmation asks the customer to respond only if the balance is correct. For incorrect, for example, you owe our client $5,000. Please confirm. That's positive confirmation. You owe our client $2,000. If you disagree, only then you need to respond. Okay, so that's negative confirmation. Positive confirmation is used when balances are relatively large. Okay, negative is when it is really small. Because think about this, negative confirmation may be where people just don't want to respond. They may think it's in their benefit not to respond. They may not respond, and the reality may be different. So we need to understand the difference between positive confirmation and negative confirmation as well, and that too is you will see some multiple choice questions on that as well. Again, the chapter may look small, but a lot of multiple choice questions for practice are going to be needed so that we can do well on the exam. Okay, thank you.